Hi there, this is the routine weekly traffic light update for the week ended on January 20th, 2017. Prior to going into the detail of the presentation, here are the disclaimer. Traffic light and capital appreciation point are the results of proprietary risk analysis model and should be used as a part of your due diligence process. Crystal Clear Indicator is not a licensed financial advisor. Investing involves risk. Here's the agenda. Let's review the S&P 500 traffic light, Dow Jones traffic light, and NASDAQ traffic lights. We'll be looking for bearish, bullish trades. Here's the traffic light on S&P 500, ended on January 20th. Let's look over the legend first. On the y-axis, that's the S&P 500 ETF daily closes, and is represented by the blue line here. Right now, we ended about 226. The green line is the proprietary indicator traffic light S&P 500. And the purple and the red lines and the traffic light here, legend here, are applied to the green line. The horizontal purple line is a long-term position indicator. When the green line across the purple line, it is less risky to take a large position in the long term. But when the green line crosses the red line, it is a better time to take a conservative position. As it is right now, the traffic light has indicating less risk because the indicator has been dropping near the red line to almost in the green line level. From the clip on November 18, 2016, we compared the current situation to that of mid-2012. In the 2012 period, as the index attempted to reach a new high, shown here, there were pullbacks. Each pullbacks were less severe than the one before to keep the breakout intact. Let's observe whether the current market shows a similar traits. Let's look at the traffic light Dow, an intermediate indicator. This indicator has a good history showing intermediate bullish and bearish signals, especially when the bullish red line and bearish green line cross over and showing divergence. In 2010 period, as the index makes a new high, so is the red line. So the market ascends. In 2011, when the red line starts showing forming a bearish divergence, meaning that as the index climbs higher, the index keeps dropping and eventually lead to the green line ascending, and we experience a more significant corrections. Let's look at the current situations. The red line starts to descend near the resistance level after reaching. To establish a long position, it is better when the red line starts to ascend or turning directions, and the green line stays below, I'll say, the red line. It is likely that the red line will start rebounded near the support level here in the solid orange line here, or the next support point will be the dash orange line here. Here's a zoom in of the traffic light Dow. There are some bearish observations as well as some bullish observations. On the bearish side, there are 2 points. First of all, the red line is descending. When the red line starts to descend at the resistance level, it is usually the end of a short-term bullish. Second, a bearish divergence could be forming. When the index is making a new high, the red line does not. On the bullish side, the green line continues to descend. So I would say cautiously, intermediate bullish trades continue and pullback are expected. As you can see, the red line made a new high recently, the highest in the past 11 years. When these similar type events happen in 2010 and 2013, they were pullbacks. I will zoom in the mentioned period in the next slide. In both situations in 2010 and 2013, the index start to descend when the red line starts to descend. The bounce starts after a cap on S&P 500 occurred. In 2010 period, There's 1 day 1, 1 day 18, 1 day 4. In the 2013 period, there's 1 day 4. Another key point is that when the red line starts changing directions, as shown here or here near the support area, it is an indication to enter a long position. In the 2010 period, I'll say consolidation or mild correction take about almost 6 months. In 2013, it's very short. It just turned around really quick. Here are some bullish and bearish observation on the current NASDAQ traffic light. On the bullish side, the red line made a new high, while the index made a new high. Second, there was a bullish crossover recently. On the bearish side, the red line started to descend on December 13th, and this piece of information was released to the subscriber website on December 13th with the email notifications. Here's the summary for January 20th, 2017. Traffic light S&P 500 is in green and shows more long-term bullish sign. Traffic light Dow and NASDAQ shows more intermediate bearish sign. Traffic light Dow and NASDAQ red lines is descending, expecting pullbacks. Consider to take some profit on a long position and increase cash positions. With unsynchronized bullish and bearish trades, the market tends to consolidate. S&P 500 cap might happen before the bounce starts. Thank you for listening.